Good morning. Welcome to Stock Market Today. It's Thursday, December 20th, 2018. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter at DanRusso_CMT. Follow me on StockTwits as well. Same handle at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics in conjunction with Chaikin Analytics. You can sign up for a free email. Head over to chaikinanalytics.com/today to sign up for that email. You can follow along with this show. So U.S. equities closed lower in Wednesday's trading, giving up early gains following the Fed's decision. Small caps and the NASDAQ underperformed, and all sectors finished in the red, but defensives did outperform on the day. Treasuries were stronger with the curve flattening. Dollar was down against the euro, but better on the yen and sterling crosses. Gold up 20 basis points, and oil was actually higher, up 3.4% after U.S. inventory data showed a crude draw. Your outperformers, again, utilities, REITs, and consumer staples. Defensives, underperformers, consumer discretionary, tech, and industrials. And as we get to the desk this morning, S&P 500 futures are up 40 basis points after coming under pressure yesterday. Asia was lower overnight, with Japan down more than 2.5%. European markets are lower this morning. Treasuries are mixed with some further curve flattening. Dollar is weaker on the major crosses. Gold up 20 basis points and oil under renewed pressure, down more than 3% today. So as we dive in here today, we're going to take a little bit of a different view. We've broken through the February lows to the downside, and I've been receiving questions, Dan, what happens if the February lows break? What are some of the obvious levels? So I decided to zoom out and look at the trend from the 2016 lows to the recent highs. And what's interesting to me is that the decline stopped at the 38.2% retracement level of that advance. Taking the Fibonacci analysis a bit further, the next key level would be the 50% retracement, which roughly lines up with 2375 here on the downside. RSI remains in bearish ranges, and you can see here longer term the negative divergences and then the shift to bearish ranges. And Chaikin money flow dips further into a bearish reading. So the indicators line up bearishly. The trend is clearly down. We're starting to look for some support levels that make sense. The decline stopping at the 38.2% retracement of the 2016 to 2018 advance is somewhat interesting to me, especially in light of some of the short-term breadth indicators that have really shown some exhaustion to the downside. Sets the stage for a potential near-term rally, but let's put it in context. It would be a near-term rally within the context of what is now a downtrend. Your market in a minute. Here's what I'm talking about in my note to Chaikin Analytics members today. Stocks sell off following the Fed's decision. We hit on that already. S&P 500 moves below the February lows. Hit on that already as well. 10-year yield falls below 2.8%. That is lending a bid to the bond proxies. Not so much a bid. They're just not going down as much as the overall market. Breadth metrics break down, confirming price weakness, but futures do point to a higher open here today. And then when we look at the power bars for the major markets, we can see the deterioration that markets were hit hard yesterday and have been hit hard this week again. We're seeing deterioration in the power bar ratios. Dow currently has 0 stocks at bullish or very bullish ratings, 4 stocks at bearish or very bearish ratings. S&P 500, 22 bulls to 129 bears. NASDAQ, 4-1 in favor of the bears here. 6 bullish stocks, 24 bearish stocks, and small caps just continue to deteriorate. 79 bulls, 516 bears. You can see the NASDAQ and the small caps, your risk-on type markets, were underperformers yesterday. Bonds catch a bid, sending yields lower. According to the Chaikin Power Bar, small cap stocks and large cap stocks have become strongly bearish. Major indexes mixed. Stock of the day today is a little bit of a special situation, EBIX. A lot of moving parts here. You can see the big gap higher in the stock, but we'll run through the analysis with the caveat being there's a lot of news flow around this one. We're really just going to use it for illustrative purposes today. EBIX has a bullish Chaikin power gauge rating due to very attractive financial metrics, very strong earnings performance, and strong price volume activity. Stock does have some negative expert activity. Very bullish stock, strong trend, weak industry group. Bearish money flow, rounding out of an oversold condition. It's outperforming the market now with this gap higher. It really is a bit of a special situation without really digging into what's going on here. I see that they have a planned IPO for an India unit. A lot of moving parts. doesn't lend itself to our analysis and our process here. But again, remember, these names are auto-generated based off the power gauge rating. It is a very bullish stock. Perhaps there's a story here that could play out. It's worth keeping an eye on, but I would suggest taking analysis a step further if you're looking at EBIX. Your sector tracker now, looking at the movement of the major sectors over the past 5 days, we can see top two, everything's down. Top two are those defensives, though, and the bond proxies, real estate and utilities. Interesting to see financials in the number 3 slot, given what's going on with the yield curve. I think what a lot of that has to do with some of the strength that we're seeing in the insurance industry group, which is part of the financial sector. Insurance, of the 21 subsectors we look at, insurance is actually the top rank based on power bars. Bottom of the list, healthcare has really come under pressure of late. Energy, obviously seeing the fallout from the decline in the prices of oil. Consumer discretionary, we've talked about that one ad nauseum. Weakness continuing to play out there. Tech rounds out the bottom 4. In the middle of the road, materials, industrials, comms, and staples. Our industry in focus today is biotech services, which over the past 6 months has underperformed the S&P 500 by nearly 16%. And the power bar ratio, which measures future potential, is very weak. 72 bearish or very bearish stocks for only 4 bullish or very bullish stocks. And even with that weak ratio, it's ranked number 11 of 21 subsectors, moved up 2 slots over the past week. As always with biotech, when you're looking at individual names, just make sure you're aware of the story, potential catalysts down the line that could really move the stock one way or the other when you're looking at the individual names. I always kind of advocate for being aware of what they have in their pipeline and what the potential catalysts could be. But some of the indicative very bearish stocks are La Jolla Pharmaceuticals, LJPC, Sarepta Therapeutics, Sarepta SRPT, and Dynavax, DVAX. All have very bearish shake and power gauge ratings. And let's take a look at Sarepta here, because I think that this one sets up the best, just not now. Sarepta SRPT, very bearish stock, weak trend, weak industry group. Seen a nice uptrend here, but really starting in October, the power gauge rating turned bearish and remains on that very bearish rating. And then in the November, December timeframe, the market and the model got into agreement as the stock began to underperform relative to the S&P 500. Money flow has been, oscillating back and forth between bullish and bearish, now on that bearish reading. Below the long-term trend line, triggered a momentum breakdown signal today. But what happens with these momentum breakdown signals is they often occur when a stock is oversold. So what I advocate for is monitoring Sarepta, putting it on a bearish watch list, waiting for a better entry, assuming you looked at what was coming down the pipeline and you're aware of the catalysts that could potentially drive the stock higher or lower. But by our process, waiting for an overbought reading, especially if that overbought reading registers with bearish money flow, could set up an interesting opportunity to the bearish side in Sarepta. So taking a look at what's trending now. Yesterday's S&P 500 gainers and losers. GE up 5.36%. 2 real news items here. Number 1, it caught an upgrade. Number 2, has plans to it filed plans to list GE Healthcare. So that got investors excited. Stock up over 5%. General Mills GIS up over 5% following their earnings announcement. Didn't see any real news to take AIG up 4.75%. PCG getting a little bit of a rebound here, up 3% after some negative news the previous day took the stock lower. FANG, FANG, kind of one of the first E&P companies to come out with some of the moves that they're making following OPEC's decisions. They've decided to cut 2 of their fracking crews. Investors like what they heard there. Sent the stock up 3%. I will note that it does have a bearish rating. FedEx down 12%. They reported earnings and lowered guidance, and that obviously is never a good sign for investors, especially for the name like FedEx that's levered to the global economy. Micron's earnings send that stock down nearly 8%. Facebook, just more negative news on Facebook. Apparently they've been sharing customer data with some of their partners. Potential violation there, down 7.25%. Allergan is suspending sales of one of their products, so that sends that stock down nearly 7%. And AMD down in sympathy with Micron and some of the comments that Micron made on their conference call and regarding their guidance. So let's talk about the 10-year yield. When we came into this year, I think the consensus view that we were going to be in a rising rate environment. The Fed was going to raise rates. And really, I mean, rates in fairness are higher than they were where we started the year, but I don't think they've reached the levels that people were expecting. Here's the 10-year yield now. It dropped below 2.8% yesterday, down to 2.77%, and now kind of testing support for the yield. That would be resistance for the price of the bonds. At about the 2.75% level. What's interesting to me is this really negative divergence coinciding with this test of the 52-week highs for the yield. And now the RSI for yields has actually dipped again into an oversold condition. So following the Fed's announcements yesterday, this move really accelerated to the downside. To me, you know, it's a sign that investors, number one, think the economy could be slowing, and number two, are just looking for safety in this market. Remember, we've been advocating for some time to position defensively. That could mean a few different things to different people depending on how they structure their portfolios and what their goals are. But one of the ways that you could potentially position defensively is to favor treasuries over equities, or if you're in equities, to favor the bond proxies like real estate and utilities over some of the more cyclical growth parts of the market. There's a lot of ways to skin that cat, but it all lines up with our theme of positioning defensively. We made that call a couple of months ago, and it does continue to play out. Breadth metrics do confirm the price weakness here. This is a chart that we look at every week. It's the S&P 500 percentage of stocks above their 200-day moving average. Now, last week, we were somewhat positive, or seeing the potential positives of a higher low here, a potential positive divergence as the S&P 500 was testing the October and November lows. That view is now negated. The sell-off really has become broad-based and widespread. Percentage of names above their 52-week moving, above their 200-day moving averages has dropped into the low 20s, and it actually has made a new low here with price. So that's a breadth confirmation to the price weakness. It negates the possible positive divergence that we were talking about last week, and it really says to me that the market is going to need some time to form a base. However, in the short term, we could be washed out. This is the percentage of stocks above their 20-day moving averages, so obviously a much shorter term measure of breadth. And you can see this has dropped down to 2%, and this is a level that over the past year has marked some tradable lows for the S&P 500 when we've gotten down here really under 10%, potential bottoms. So if we combine this near-term, very washed out short-term breadth with the fact that the market found support at the 38.2% retracement level yesterday, you could argue for a near-term bounce in the market. But as I said, that bounce would be counter-trend in nature. The trend for the S&P 500 is down at the moment. Global markets continue in a downtrend. You can see below the 50-day moving average, below the 200-day moving average. This is the iShares MSCI ACWI ex-US, so a measure of markets outside of the US. RSI firmly in bearish ranges. But what's interesting to me here is that relative to the S&P 500, it has kind of formed a base and is now breaking out. Perhaps investors are rotating money out of the U.S. and into other parts of the world. There is a bit of a valuation case to be made for that. Some folks are talking about it, and it's interesting to see it starting to play out here on the charts. So that's what we have for today. You can get your daily stock ideas for free if you sign up for that email that I mentioned. The email is called Chaikin Analytics Power Feed. If you head over to chaikinanalytics.com/today, you can sign up for the email. It's free. Stock ideas every day. You'll be following along with this show. A lot of what I pull out and talk about on this show actually comes from that email. So it's a good opportunity for you to follow along with what I'm talking about today, especially if you're not getting my notes on a daily basis. And as always, we could appreciate you sharing our link. If you're getting value out of what we're talking about here every day, if you like the show, we would really appreciate you spreading the word. And just a note, I am off tomorrow. My colleague, Nick Webb, will be filling in for the show. Have a great weekend, everybody. We'll be back next week.